This is Halloween. This is Halloween. 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 Yes, my friend. Today we're talking about horror investing stories and zombie companies. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast, and I have an announcement to make, Véro, and you're probably not even aware of it, but we are now podcast millionaires. We didn't make $1 billion. I just saw your face. No, I'm sorry. Sorry to break it to you, but we reached over 1 million downloads combining the Dividend Guy podcast and Moose on the Loose. So I just want to thank you all listeners for that many downloads. That's kind of crazy. It's been a few years that we're doing this. We're having a lot of fun, but just to reach that milestone, I don't know. I just wanted to celebrate with you guys.
Well, that's crazy. That's like a whole bag of candies for us for Halloween.
Yeah, there you go.
All right, so thank you from myself, also listeners. Mike, I'm not following much like the Moose on the Loose stats, so I'm glad that you did it for us. All right, so today is our Halloween special. Listeners, you may not know this, but Mike likes Halloween a lot. When
Probably
his
too
children,
much.
probably yes. When his children were younger, we used to go trick or treating with our two families, and Mike was just found of zombie costumes. And these were fun times. We've decided to leave them in another way today because the kids are all grown up. So, it's another way to talk about horror and zombies, but we're not so fond of horror investing stories and zombie companies, right, Mike?
Yeah, that's a bit of a different story, right? I remember one year I had a speaker with zombie noises and a chain that I was just letting roll on the asphalt, running across the street and screaming like there's no tomorrow. So yeah, definitely, I scared more people, and probably created a few commotions, but I just had so much fun. So, unfortunately, today we're going to talk about stories where value and money was massacred. And we have also companies that are going nowhere. This is what we call the zombie companies.
Mhm.
I mean, it's an episode to have fun. Yes, we're going to have some investment lessons, but don't take it to the first degree, please. So I repeat, we're having fun today here. Okay. So don't go crazy and don't go sell all the companies that we're going to talk about today. But we do have a lot of great investment lessons from those, anyways.
All right, so as the name suggests, horror investing stories are the ones we all try to avoid, and the ones also that happen when everything turns bad. So let's start with one we discussed already on the show, but that illustrates the concept perfectly. Algonquin Power, QN.TO. How did it go from an investor's darling to a horror story?
Yeah. I mean, this one is famous, but there's like a chapter 2 of this story this year where the company slashed its dividend a second time. So,
Mhm.
like a good horror movie, like one is not enough. We needed a sequel. Algonquin started its path to growth by acquisition. So, aggressively acquiring utility assets, going through the greening process. So they were literally like buying monopoly territories and then introducing more green and renewable energy into those. That was trendy. The numbers were great, especially as the interest rates were low. And unfortunately, we discovered a bit too late that most of the debt was variable.
Mhm.
Ironically, the CEO doesn't and management team didn't seems to care about that. But I mean, to their defense, interest rate rose very quickly. That completely destroy the company's balance sheet within seconds. Actually, it was faster than when Freddy is shredding his victims. We had like one bad announcement after the other, and on my side, I sold after the first dividend cut, and a lot of investors. We're going to talk about a lot of this today. Decided to hold on to their shares, thinking, well, eventually they're going to things turn around. They're going to turn things around, and I mean, unfortunately, we had the sequel this year. So in 23 they cut the
Mhm.
dividend, in 24 they cut the dividend. At this point, I don't see why I would have kept my share. So I'm glad I did back then. But you never know how it's going to turn out. This one, I was just happy to sell, take the loss, and move on.
All right, so I was surprised to see the next one on your list, Mike. We kind of said good things about Dollarama, but its US equivalent, Dollar General, appears to be a horror story. Why is that?
Yeah, well, apparently they're not that equivalent or not similar, right? So this story starts with all good horror stories. So very smoothly, everything was perfect in a little quiet town, especially where Dollar General focuses on those quiet towns with like small
Hmm.
stores, reporting good numbers quarter after quarter. The dividend triangle was strong. The company was on a long streak of dividend growth rate. So literally everything was perfect. And then over the past 12 months or so, they started to report mixed quarters where revenue increases, but it's more driven by the opening of new stores and not comparable stores. And when you look
Mm.
at retailers or restaurant chains, it is a crucial metric to look at either same store or comparable store. That means we are looking at the existing stores last year versus this year and see if those stores are able to generate additional growth. In other words,
Mhm.
gaining market shares or attracting more customers, selling them more stuff or at a higher price. But when a chain is able to grow their revenue only by opening new stores, I mean, it's going to be good, but just for a short period of time because the market will eventually be saturated. So it's
Mhm.
important to find ways to grow organically. Combined to that, earnings per share are literally in a free fall. So that is, of course, explained by higher expenses, interest rate, inflation, putting margin under pressure, and earnings per share just the last quarter, they were down like 20%. That's not good. So when you have weak revenue growth, no organic growth at all, earnings that are in free fall, and then the dividend is stagnating, well, even though the payout ratios are still good today, I mean, we're in a long agony right now. Investors are tortured like we had in the Saw movie, literally. I told you we're gonna have fun today.
I love it. All right. So the next one also used to be much appreciated by investors. Walgreens Boots Alliance, WBA, turned into a real nightmare. How did it happen?
Yeah, imagine a pharmacy that doesn't do well during a pandemic. It's kind of like literally counterintuitive, right?
Right.
To be fair, before COVID, a long time ago in a galaxy far, far away, yeah, I'm not done with the movie references. We liked Walgreens at DSR back in like
Mhm.
2013, 14, and so on. Uh, However, the dividend triangle started to weaken a while ago, and we eventually sold it at a good price. So we got away way before the big trouble started to happen. Over
Mhm.
the past few years, though, it had become a literally a nightmare where the company struggled to generate more growth. So lack of revenue growth. The earnings per share were literally hectic at best. And unfortunately, the dividend got cut faster than Mike Myers and his snipe. So the story here, unfortunately, is, and it's kind of interesting because we may be thinking, well, Walgreen is a dominant player in the pharmacy.
Mm-hmm.
They are serving pretty much all Americans across all states, and yet they struggle to generate revenues. They struggle to generate good margin. And even if that business model was great 10 years ago, today, very tough market, very difficult to grow, and eventually led to a dividend cut and a stock that lost, like, I think 90% of its value over the past few years.
Okay, so the last horror investing story would like to share today is a stock that you used to own, Mike. So VF Corporation, VFC, was full of promises. Why is it now on the horror side?
Yeah. So for many, many years, VF Corporation has built an amazing expertise and reputation in managing brands. So
Mm-hmm.
they were not really an apparel company, but rather a brand manager. They used to like buy brands, make them better, make more profit, and then sell some of those at a good cash flow, and then reinvest that money in the next acquisition.
Mm-hmm.
That worked incredibly well for several years. Actually, they reported 50 consecutive years of dividend increase. And then it's like the company was possessed because nothing worked anymore. And in the same year, they cut their dividend. It's kind of like just crazy. They had a huge success with Vans, that brand that, I mean, your children love it, mine as
Mm-hmm.
well. But for some reasons, it is losing steam very fast. So weaker sales, weaker earnings, and then the thing about apparels is you have to spend a lot of money into marketing. So when you're having a hard time selling your stuff, well, it kind of had like you're stuck with inventory. You have to run more promotion. You have to sell stuff at more rebates, and you literally have to get rid of your apparel for to get ready to the next season. So that hurts big time revenue and earnings. On my side, I started a position during COVID as a speculative play. That didn't work out well. Fortunately, I had many speculative plays at the same time. This one, I mean, that's there's a reason why you say, oh yeah, I'm gonna take a guess. I'm gonna bet money on it instead of I'm going to invest for the long run. But
Mm-hmm.
I thought, yes, they had a lot of like problems with the supply chain, and some retailers were closed, and then a big portion of their manufacturing is in China. So, like, the lockdowns over there didn't help. But it was more than that. Going forward, they still struggle to, I don't know, like, stay relevant. We always thought, okay, the new back to school promotion is going to bring that up. They went through a big restructuring plan, but they don't see the end of it. So there's still hope for a very, very long time in the future. But I sold whenever they cut their dividend because it's part of my investment rules.
Mm-hmm. Before we move to zombie companies, Mike, could you tell us what all these stories have in common so investors can avoid them?
So here's the trick. Most of the time, you will not be able to avoid those. And I know, I mean, if you don't have the company in your portfolio, if you sold it before, you're going to say, oh, the writings were on the walls. It was obvious. But I mean, like a good victim in the horror movie, when you watch it, you're like, "Oh my god, why are you opening this door?" But as an investor, you don't know why, but you still open that doors, and there you go. You get the monster in front of you, and get you get eaten alive. There's nothing you can do, but you have diversification. So in a good horror movies, you have like a dozens of characters. You can kill nine of them, and then the three last will survive. Well, fortunately, with your portfolio, it should be quite the opposite.
Mm-hmm.
So going back to AQN and VF Corporation, AQN was a normal size position in my portfolio, around like 2-3%, and VF Corporation was smaller because it was identified as a speculative play. So even though I lost about 50% on AQN and VF Corporation, in reality, that didn't hit my entire portfolio that much. It was not a
Mhm.
good year. It was not fun, but losing 1 or 2% of my entire assets was not the end of the world, especially because I had other great companies to compensate. One trick that we have developed over the years that works pretty well is to focus on the dividend triangle.
Mhm.
The same way we avoided the WBA, so the Walgreen debacle, just because we saw revenue trending, like stagnating. We saw the earnings that were hectic, and then we just decided, you know what, it's time to let go. We made money on this one, that's good, let's move on. So making sure that you have strong fundamentals is key when you invest, and the diversification would be your best ally against any horror stories.
Hey, listeners, you have heard us talk about DSR so many times. I think it's time to invite you to join Dividend Stocks Rock and become part of our great community. At DSR, you can rethink your portfolio with our portfolio models, buy the right assets with our stock cards and stock screener, stay the course, grow your conviction, and get educated with our weekly newsletter and exclusive webinars. What else could describe this risk-free investment, Mike?
So in 2017, I took three major decisions. I quit my job at the bank, I decided to go full-time on DSR, and I decided to manage my portfolio account. So that pension plan was $108,000. I was about to invest it at a all-time high market, and thank God I had DSR tools to help me out. So over the years, I've built a platform to help investors invest with more conviction, giving them clarity and make it easy to invest and manage their portfolio. Fast forward today, this portfolio is now almost at $300,000, and it makes it so easy to just use a DSR Pro platform to manage a portfolio, buy and sell, and do everything within minutes.
And you know what, listeners? We have a special offer for you. Subscribe to DSR now at thedividendguyblog.com/deal to get a 15% lifetime discount. That means your membership will never increase. Again, thedividendguyblog.com/deal. See you soon during our next private webinar. Now, here's the informal definition of a zombie: a person who is or appears lifeless, apathetic, or completely unresponsive to their surroundings. So this does not look so good for a company. Altria Group, Altria Group MO is a good example, right, Mike?
Yeah, so just to make a distinction, because sometimes we have, I think it's Bloomberg or BlackRock that has the definition of a zombie company, meaning a business that is not able to pay all their debts. But right, so they're like in technical bankruptcy when they look at at their balance sheet, but they're still operating. In this episode, we're just talking about companies that are really stagnating, not going anywhere.
Mhm.
So it's not exactly aligned with the classic definition, just to be clear. The other thing is sometimes, like Altria, a zombie will feels like it's like there's a human behind it. And I mean, I am a big fan of The Walking Dead, and
Mhm.
sometimes we've seen characters in this series that got attached to people because they knew I mean, there was like their children or their wives or whatever, and even if they turn into zombies, they just didn't want to let them go.
Mm.
And this is the case for Altria for a lot of investors, and we all know the saying about including their ticker like mo money. Yes, it is a cash flow making machine, but it's not going like it's not going anywhere. My dislike for Mo is known since my article days on Seeking Alpha. I think it was like
Mhm.
2016 or 2017. I don't remember quite the date, but I do remember the hate. A lot of investors, they were just like, "Are you crazy? This company is going to continue to generate money forever. This and that. It's a cash flow making machine." I'm like, "All right, that's fair." And ironically, there's a boost of life in this zombie business in 2024. But keep in mind, it's pretty far from its peak value of almost $80 a few years ago when I wrote those articles. And the
Mhm.
problem is quite obvious: stagnating revenue. We are at a place where Altria's playbook is, oh, we have a bunch of dependence on our cigarettes and on our other like tobacco products, so we're just
Mhm.
going to increase prices, because literally there's like always demand for those products, so of course it is generating tons of cash flow. But the revenues are stagnating, the earnings per share are hectic. I don't see this company being able to continue to increase its dividend forever. And even then, I mean, yes, you get a good yield, but we're talking about years and years where, oh, we got a small bump of life right now, but we're still not. If you're a long-term investor and you've been holding Altria for like the past 5 and 10 years, you're not making that much money compared to what happens on the stock market. So I'm not
Mhm.
convinced that it's going to grow again in the future, basically. So that's why I still think today, that is as a zombie company.
Okay, another company we've mentioned a few times that seems to go nowhere is Transcontinental TCL.B.TO. How is that, Mike?
Well, TCL belongs to the past. It used to be a major printing company. So we're
Mhm.
thinking about flyers, newspapers, magazines, all those words that your children have no clue what they are. So that sounds like a zombie with a big Z. Uh, they tried to turn around their business by buying a packaging company in
Mhm.
2019, if I remember, or 2018, 2019. But ever since, the earnings per shares are struggling, their revenues are not growing, and they stop increasing their dividend in 2020. If one company screams dividend cuts, it's DCL. It's just a
Mhm.
matter of time.
Right.
The company has not recovered their peak price in 2018 when there was a lot of hope, because they tried to change their business model into a printing slash packaging company. But the company is really going nowhere ever since. And besides, there's a good yield. That's about your investment thesis right there.
Okay, so I've decided to combine the next two, even though they're completely different, because you don't own them anymore, but you used to own them, Mike. So why do you now consider Magna International and Andrew Peller as zombies?
I'll start with Magna International. I sold it this year, actually, a few months ago during summer, I think. And this one could get back to life, but I did not want to wait more because I was afraid to get infected. The thesis is still good. It's still one of the largest auto part manufacturers. They have strong bond with like all the big guys in the industry. They created a sticky business because they build auto parts in partnerships with car manufacturers. So as both the client and the manufacturer is involved in the creation, it's kind of hard to change your suppliers. So they have a really good business model there, and I still like the investment thesis, but the dividend triangle is so hectic, it doesn't make any sense. The revenue follows a highly cyclical business, which I understand, but the problem is the margins are getting squeezed over time, and it's hard for them to generate consistent earnings per share growth. It just goes up and down, and over the past few years, the dividend growth has slowed down. So because all of that, I decided to sell. So it's a good example where I still have a very strong investment thesis, but I must admit that I have to be wrong somewhere because the numbers are not backing up the narrative. And even though I sold and made a few bucks, it was definitely not one of my best buys over the past few years. in terms of opportunity costs, I could have done a lot better. But at least I didn't lose any money, as I did with Andrew Peller. But this one, I cut it loose and I did not let it infect the rest of my portfolio. So that is also an important. I mean, yeah, I know, I'm making a lot of jokes today, but there are some lessons behind it. When the dividend triangle does not match your investment thesis, or when your investment thesis is no good, like Andrew Peller, that was the perfect example. I bought it in 2018, actually 2017, based on that investment thesis where it was a dominant player in the wine industry in Canada, and it was growing by multiple acquisitions. So they were able to do cross-selling opportunities, benefit from economies of scale. Unfortunately, 2019 was the last growth move they made. And after that, well, COVID happened, but they kind of like took a huge bite. And it was just hard for them to manage their balance sheet, interest charges, expenses growing everywhere. And because of that, they stopped growing by acquisition. The problem, once more, lack of organic growth. So if your business is not able to grow organically and you just rely on acquisitions, it's not going to work forever. So I sold the stock before it cut its dividend. The dividend is still active. They have not increased it for a few years now. But I'm glad I got rid of it. Like, yes, at a loss, but it could have been worse going forward. The company is just going through like hurdles and hurdles. And yeah, there's just no growth anymore anywhere. So this one is a almost dead zombie company, and I don't know how this story is going to end up, but I hope there won't be another sequel.
Okay, so when I saw the next name, it brought back good memories. And I'm sorry, listeners, I don't have like all those Halloween jokes that Mike has, but I used to own a Ford Escape, and boy, did I love this car. It's my favorite so far. So unfortunately, the company does not bring the same feelings, right?
Well, I mean, it's too bad because I like Ford as well, but every time I think Ford is back with solid fundamentals, well, it's not. So it's the kind of company that will be around in 50 years, but still the return will be highly volatile, to say the least. It reminds me. I had a discussion with my son William because he was pulling charts for airline companies, and I drew the parallel here where we do use airlines all the time. We were just talking about traveling before we recorded this episode. We do use cars all the time, but for some reason, those businesses, they have such a hard time making consistent profit. So the car industry is highly cyclical, a lot of competitions, margins are thin, it's hard to be profitable and likable over a long period of time. So this is not an industry I would be interested in investing in the future. I never held Ford in my portfolio, but from time to time I was like, maybe Ford is a good investment. And it kind of like fails investors over and over again. So besides the iconic name and the Mustang that I love, I just have to let this one on the side.
Last but surely not the least, Ryokan REIT. It is still popular among dividend investors, Mike. So why does it deserve the zombie tag to you?
Well, actually, it was a zombie before it became a zombie. This one, I didn't like Ryokan before COVID. I didn't like the fact that the dividend triangle was weak, that they stopped increasing their dividend. I was kind of like, hey guys, that's not a good REIT. I know it's a big guy, it's a big player. The monthly juicy yield is there. But I don't like the retail business. I don't like when a company struggles to grow. And of course, when you have a high yield with no dividend increases and a weak dividend triangle, well, big surprise, we got a dividend cut. Now they're coming back with a different story, a different narrative, the one of diversification. They're going for residential, like condos and apartments. But I mean, I just look back at their investors' presentation. Retail is still 85% of their business. 11% is for offices, which I mean, yes, it brings diversification, but right now it may not be the best place to be in the REIT industry, and the rest is like roughly like 4 or 5% in residential. I mean, so much of the story for diversification. I'm now just buying it, and it's been a while since they cut their dividend. They have not been able to bring it back. So yes, the payout ratio now is like good, but they're not in full growth mode, and they have not completely changed their business model either. So I rather let it rot on the side.
Again, Mike, what do these companies have in common that could help investors identify them before it's too late?
In those cases, is definitely the perfect example of the narrative, so the story versus the numbers. So, if you do not have a good reason to have a company in your portfolio that is backed with fundamentals like numbers telling you that the story is true, well, if you let it go, you're going to avoid a lot of pain. So, don't fall in love with your zombies.
And we wanted to end with hopeful stories, listeners. So here are the back from the dead companies, 3M and Silogist. To be honest, I would like have never expected this. So what brought them back to life, Mike?
It's crazy, right? I mean, and I thought it would be an interesting twist to talk about those that went back from the dead. For 3M, they went into all the possible bad news they could find for many years. It was a huge struggle. They ended up completing their spin-off,
Mhm.
clearing like this, like making the business simpler, cleaner, leaner, uh getting rid of their litigation, going after that, and then there's a huge comeback this year. I'm the first one surprised. I mean, they had to dividend to cut the dividend in disguise, so in the rebrand and the spinoff, but
Mhm.
yet they made it happen. Is it going to last? I hope so, because it was an amazing company like 10 years ago. So hopefully it's going to continue to thrive going forward. And it's a rare story where I'm just like, wow, that's just very surprising. Another one was Silogist. Silogist, I've talked a lot about this one as well. It was in my portfolio, and there
Mhm.
was a huge switch in narrative. So at the beginning, and when I purchased that stock in my portfolio, the narrative was, oh, it's kind of like a boring technology company, more focused on generating cash flow and offering software services to organization and governments, municipalities. So a lot of recurring revenues, making their money, distributing, increasing their dividend for 9 consecutive years. And then there was a change of CEO and a change of narrative. The new
Mhm.
CEO, younger, more aggressive, decided to transform Silogist into a growth company. The problem was, at first it was really exciting, and then the company kind of struggled. It was They were not able to report steady earnings increases. They went into a lot of problems. They had to cut the dividend to focus more on growth by acquisition. I sold because it's part of my investment rules. You cut the dividend, I get rid of you, and I don't move, and I don't look back. Well, surprise! Today it's now trading above $11. Coming back from the dead, growing, showing more recurring revenue. So kind of like an interesting story when you be thinking that this stock was trading around $5-6 not too long ago.
And Mike, couldn't Manulife fit this back from the dead category too?
Yeah, definitely. It was not dead, but it was definitely a zombie company for many years. And this year's up like by 40%, completely changing their narrative. Outperforming the other big life insurance companies such as Sun Life and Great West over the past 5 years. I mean, 1, 3, 5 years, almost 10 years as well. Very surprised here that Man Life made such a comeback. I've heard that Man Life was undervalued for the past like 20 years. So it's about time it's coming back to life. But I'm glad for investors. I mean, that one I didn't see it coming at all. And to be honest, I still wonder why the stock is up that much this year. But anyways, that's probably another story for another day.
But Mike, I can help adding a note here. Since we're all about Halloween, I get chills thinking that back from the dead companies could lead investors to hang on to their zombies or horror stories for too long. So, how to draw a line here?
Yeah, there's a big hanker bias here. I used to golf more for fun than anything else because we golfed together and we had a lot of fun. And I'm not too sure we had a lot of golf. But after the end of the day, I was always the one talking about that one crazy shot where my balls went through like a huge lake and ended up on the green, or went above
Mm-hmm.
like a huge tall tree and like did an amazing par on, or just like save a hole there. But I kind of forgot to tell the rest of the game where I averaged between 100 and 110, and that was not such a great game. So I just like to remember the good shots and forget about the others. So keep in
Mm-hmm.
mind that for each 3M or each Silogist or Man Life story, you're going to find a dozen of Algonquin of stocks that goes nowhere.
Right.
That's why I sell according to investment rules, and I have absolutely no regret because I rather focus on my strategy and improve my conviction than get stuck with dilemmas with those kind of companies. Not too long ago, I had a discussion with a member about AltaGas, and it was kind of fun. We were just talking about stocks and experience like this. And he said, "Yeah, I held on to AltaGas after they cut their dividend." So, long story
Mm-hmm.
short, the company made a major acquisition in natural gas in the U.S. They get into more debt. They had to cut their dividend, switch the business around, and he recovered his money roughly 7 years later. A lot of investors would say, see, I was right to wait for those 7 years because now I got my money back. So patient paid. And actually, that's not what he told me. He was like, Mike, I wasted 7 years waiting. So the opportunity cost, when you look at how the market did over the past 7 years, I would have made so much more money if I would have
Mm-hmm.
sold back then and reinvest that money in something with stronger fundamentals. And that was the lesson right there. The opportunity cost. It's normal to make mistakes. We all make some. The key here is first to be diversified so those mistakes do not eat away a big chunk of your portfolio. And the second thing is if you can quickly sell and move on, chances are you're going to reallocate most of that money in winning companies because it's really hard to be wrong after being wrong after being wrong, unless you have a very poor investment process. I mean, that's not a mistake anymore. That's just like not being able to read financial statements. So overall, that's the key here. Having a strong investment process, having clear rules, super easy to follow, and just follow them instead of like, again, opening the wrong doors at the wrong time, knowing that there's a monster right behind it.
Mm-hmm. Well, that was pretty fun, Mike. So thank you for yet another memorable episode. Listeners, don't be a zombie and make sure your holdings fit your strategy by downloading the DSR stock checklist at thedividendguyblog.com/checklist. For the show notes and related content, visit thedividendguyblog.com/198. Never miss an episode again. Hit that subscribe button now and leave us a 5-star rating. Next week, we'll show you how to match your strategy with your schedule and your skills. Until then,
Stay
stay
invested.
invested.
Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.